All right, so moving on to our financial planning topic. Let me pull up my whiteboard first here and make sure that's all good to go. And you're going to see me looking down as I draw on this whiteboard. But here we are. This is what we've been calling our financial 15, and that's 15 minutes, give or take, of a financial planning topic that can have significant impact on your retirement plan. So if you're just joining us on YouTube for this is the financial 15, as I just said. So hit the like, subscribe, and notification button, and you'll never miss a video. Okay, so let's talk about today the 5 most common, I keep saying most common. I guess it all depends on who you are, but the five common retirement mistakes that I see. And we're going to just go through them one by one. So let's go with number 1. Not planning for or considering a significant market loss. So this may kind of seem like, okay, Mark, well, wait a minute. Everybody thinks about that. It keeps me up at night, what's going to happen. But, a lot of folks don't think about it. Or, a year ago, not a year ago, I guess, because we were starting to have our difficulties a year ago. Yeah, sure, it's March. So we were seeing slides in the market. But let's go back to 2020. So 3 years ago. 3 years ago in 2020, when I was teaching my live classes, I was reminding people that the markets could lose money. And talking about the Great Recession and saying, you could see a 20, 30, 40% drop in your holdings. But people kind of just had, they plugged up their ears. I've been doing well. I'm doing it on my own, or my financial advisor is great. And we keep making money every year. And that's how it was for a decade and a half or more, with some blips along the way. But it's been more challenging for sure since the pandemic. But even the pandemic kind of gave us this false security around because in March 2020, the markets dropped dramatically, and they started to come back again really strongly in June. And we have this, you've heard it, this V-shaped recovery, and it just ran until the end of 2021. And then 2022 was difficult. And for a lot of you folks listening to this, whether live or on YouTube, many of you are probably coming into retirement or so you're nearing retirement or already in retirement, and you have this worry zone, I call it. And that's healthy, by the way. It should be managed, but it's healthy, because if you're not paying attention to this, not planning for or considering a significant market loss and over a longer period of time, because don't forget, I think that we could be in this for the next 1 to 5 years. And it could, modest returns, we're going to talk about that in a minute, it could be much longer. But you run into the sequence of returns risk. So what is sequence of returns risk? That is when you have negative returns early in your retirement that you can just never recover from. Because if you're not invested properly, if you don't have a proper segmentation, financial plan, etc., then you're drawing from investments that are potentially down. And last year, you got hit with the bond market being down and the stock market being down, sometimes considerably. So even your safe, air quotes, if you're just listening, bond money was down. Then you're drawing on this money because you have to spend that money, or you want to spend that money, and that can have a significant permanent impact on your investments, therefore your standard of living in retirement, and your chances of having a successful retirement. So successful retirement is different for everybody, of course. Most people, they want to have their needs taken care of. They want to make sure they've got money at the end of their life. And then whatever's left passes to their heirs as efficiently as possible. Now, some people say, I want to spend my last dollar or last day on earth. And that's a really, really nice and kind of cute statement. But how are you going to ever plan for that? So you want to make sure you've got a buffer there, and then you decide where that buffer goes, because the thing is that you can plan to 85, but you might be here till 95. And frankly, if you plan to 95 and you're going to spend your last dollar on your last day here at age 95, and you live to be 96, that year from 95 to 96 is going to be pretty terrible. So you've got to plan for a significant market loss, because it's very likely to happen to you in 20, 25, 30, 35 years of retirement. Probably a few times during this time. So you have to plan for those things and be aware of them. And there's things that you can do to mitigate those. You've heard me talk about it. The 3 pillars of investing. If you haven't heard that rant yet from me, the 3 pillars of investing, go to our website, attleborowealth.com. Go to the services section, drop down at where investments are, and you'll see a video, 3 pillars of investment, or search it on the YouTube channel. Okay, so you got to pay attention to a significant market loss. How about even or just as bad, I guess, as a significant market loss is not planning for or considering slow growth. So I want you to read this with me. I'm right here. We expect U.S. equities, that means stocks, to return 4.7% to 6.7% over the next 10 years. So that's from Vanguard's 2023 Economy and Market Report. 4.7% to 6.7%. Anybody remember what inflation is right now? That's 6%. So if you return 4.7%, after inflation, or let's split it in the middle. Let's call it 5.7%. If you return 5.7%, you're losing 0.3% a year, right? You're actually down 0.3% a year because your money is worth less. So this also is a gross return. That means you have to back out fees, and we're going to talk about all that, and expenses. So that 5.7% can come all the way down to 2 to 3%. So now you're really losing money. So we hope that inflation of 6% isn't with us for 10 years. That would be really challenging and hard to overcome. But just this short growth or small amount of growth over 10 years can be devastating also to retirement if you're not considering it. Because some people still think, when I was early on, when I went out on my own and became an independent advisor, I was invited to speak on CNBC. And the discussion was, I can't remember the other anchor, but Larry Kudlow was the one anchor. And we were talking a little bit before the episode aired. And the discussion was, because it was right coming out of the Great Recession, and there was some discussion about allowing people to remove money from their 401ks to invest in the housing market, real estate market, which would have been a horrible plan, obviously. But Larry Kudlow said, well, what about Mark, talk about the 12% average return of the stock market over 30 years. And a lot of people still have that in their head. Well, the market's going to return, somewhere between 11 to 12%, once we come out of this over X number of years. Well, that may be, and let's hope it does. Hey, listen, let's hope it's 20% it averages. But we better be prepared for more modest returns like 4.7%. Because this period of time that people are talking about, this 30-year period of time, that's it's not arbitrary, but it's really insignificant to you, because this might be, what would that be? 1997 to 2023. What does that matter to you? This was your working years, potentially. What you've got to worry about is 2023. And let's say the average of the markets over that time, it's actually come down. I think it's probably about 8. Let's just call it 8% right now, where it historically, you really were looking at 11 to 12%. But the average has come down over the last 30 years. But if your next 30 years is 2023 to what would that be? 2053. Ooh, that's a long time from now. The question is, what's that average going to be? If it's going to be 4.7% to 6.7%, that's going to be troublesome for a lot of people. So Vanguard's only predicting this for the next 10 years, and that's great. So that's good information. But it may not pan out that way, but you have to focus on what your period of time is, not some number that a mutual fund or an investment manager says this was the return over the last 30 years, because that's not your 30 years. I hope that all makes sense to you. The other thing you have to consider when you're talking about slow growth or even no growth is you've probably heard the the example of the lost decade. So from the year 2000 to the year 2010, if you listen to Susie Orman and invested just in the Vanguard or Fidelity S&P 500 index, low cost fund, and it's important to do that, and we're going to talk about that. But if that's all you did, does anybody know what your rate of return was from 2000 to 2010? So I've got a really smart and sophisticated group of individuals here, and I'm willing, a lot of people are thinking right now that rate of return that you received was 0%. So from 2000 to 2010, almost to the point, the S&P 500 returned 0%. Now we're going to talk about investment costs for a second, and this doesn't account for 1% advisor fee, 2% fund fees, another 1% in trading fees. So that's 4%, folks. So that's a negative 4% return that you've actually experienced during that time. You've got to be aware of these things, and you've got to figure out what awareness is key. And then once you identify these potential issues, you have to figure out ways to address them. So that's mistake number 2, not planning for or considering slow growth. All right, now we've talked about fees, but paying excessive fees and costs. Listen, I'm a financial advisor, financial planning, my financial planner. Certified financial planner. My clients come to me because they want help with their plans and their investments and tax efficient planning, and we charge a fee for that. So I'm not saying, of course, that folks shouldn't pay our services, but you've got to check in with these things and make sure there's a value for that. What are you getting for these fees when you're talking about advisory fees? I was asked to speak. You may have heard this before, but I think I'm remembering right that it was in Dallas, Texas. And I was asked to speak to a group of financial advisors, and there were probably 100 some advisors in the room. And right before me, a company came up, a company from the Pennsylvania area called SEI came up, and they said the fair cost of just managing investments. So to pay a financial advisor to just handle your investments, they said the SEI was 0.25%. The average cost in the industry is still well over 1%. I think it's 1.05. So they talked for a while. They shared their study. And by the way, this study I can't find it on, I was looking for it this morning, but I can't find it on Google anymore. So maybe they got some pressure. I don't know. But they talked about the study that they did that showed the real value of just asset management, just helping people with their investments only, was 0.25%. And the industry standard, even today, is 1.05%. So after SEI came up, I said that, and everybody in the room was grumbling. I had a chance to come up and talk about financial planning. And I said to them, okay, well, SEI just told you that everybody in this room is overcharging. And by, in this example, 0.80%. I said, this is how you can bring value to your clients and maintain those relationships and cover that additional fee. And that, I always tell people that our typical fee is 1%. And it goes down from there depending on the amount of money that you have with us. But and I acknowledge that about 0.25% goes to the investment management portion of it. And we have a different way of investing or managing investments and choosing investments. And I'm happy to share that with anybody who wants to talk about it. And you've heard me talk about it before, the account segmentation. And, we specifically hired a research group to assist us in our research and implementation of these strategies. But we account for that about 0.25%. The entire remaining 0.75% of that one is financial planning. Financial planning, tax efficient planning, saving our clients millions of dollars potentially and often over their lifetime just by having things situated the right way and doing it and reviewing it every single year. Very, very important. But that's where the rubber really meets the road for us. So if you're paying advisory fees, what are you getting for those fees and are they fair? Look, there's still people that are charging 1.25%, 1.5% just for managing investments. I don't think that's fair. I don't think it's appropriate. There are also folks who, they'll, like I just told you, we hired a firm Cornerstone portfolio and research. Sorry, Cornerstone, if you're listening. Cornerstone Portfolio Research. They're strategic partners of ours. We pay them a fee to help us do all this work. We don't charge our clients that fee, but there are advisory firms that do that. They'll say, we're going to send your funds over to this investment company, XYZ investment company, and we're going to watch them, and they're going to manage your assets. And then they'll add. So not only are they charging you, 1%, but then they're going to add 0.25% on top of that, or whatever that investment company's fee is. We don't do that, and I don't think that's appropriate. The research that, I didn't mean to erase that. The research that we pay for. So I'll get off my high horse and my soapbox there. So advisory fees, what are you paying and what do you get for those fees? Mutual fund fees. I want to share with you something. So we all know that mutual funds can be more expensive. Sometimes it makes sense to pay those fees, and people always zero in on these expense ratios. Well, gosh, that mutual fund costs 1%, costs 0.95%, or you can buy an exchange traded fund for 0.1% or 0.03%. And that's a great argument. And we use a lot of exchange traded funds in our portfolios because they are cheap and efficient. But sometimes it makes sense to use a mutual fund because you have an active manager there who is looking for opportunities. And it only makes sense if if they can help you earn that extra money beyond what you're paying them. Pretty simple concept. However, we know that statistically something like 92% of the fund managers out there stink or are mediocre. So we only have about 6 or 8% of the population of professional money managers who can earn their keep. That's why I always challenge people who want to do this on their own. If the majority of the financial professionals out there have all the resources and all the technology and have people all around the world helping them put together these portfolios, if most of them can't perform well in a portfolio, I don't know how an individual thinks that they'll be able to, but that's not for me to decide. But people always talk about the expense ratios of these mutual funds, and they should, but there's more to that. So I put together this little chart here. So here's an example of mutual fund fees and things you have to look out for. So of course, this shows a 0.9% expense ratio on $500,000. And that's what people think about when they think about mutual funds. And that could cost you a whopping $4,500 a year. And of course, that's going to affect your returns. But what about other costs, these phantom fees within mutual funds that you have to watch out for? Well, 1.44% is the average. The 0.9% is the average. 1.44% is average transaction costs of in mutual funds. That's another $7,200. Nobody talks about that one. Everybody focuses on the mutual funds. You have to be aware about these things. There could be another 0.83% in what we call cash drag, and that's another $4,150 a month, or excuse me, annually. If I said a month for these, I meant annually. On $500,000. So what cash drag is when mutual funds have to hold a significant amount of cash to pay shareholders when they want to redeem their shares. So mutual funds have to have funds available to, if I go in and I want to liquidate $500,000 of a mutual fund, unless there's restrictions in place in that mutual fund, at the end of any given day, I can liquidate that $500,000, and that fund company has to send it to me. Some funds have distribution liquidation or restrictions. They'll only liquidate periodically, but that's cash drag, and that can be expensive. That can be up to that's an average of 0.83%. I didn't make these up. I pulled this from a resource. So these are other costs in mutual funds that you have to be aware of when you're at any time, but certainly when you're in your retirement. Annuity fees and costs. We hear a lot about annuities and their costs. And again, annuities can be a powerful tool inside of your retirement plan if they're in the right buckets, if they're taxed the right way, and if their expenses are reasonable. But you have to understand the details about that because those annuity fees can go from 0 to 6% or more. So you got to be aware of that. The next big mistake is not knowing your numbers. We've talked a bit about this. We went over this in a webinar all by itself, the Financial 15 of a webinar. But if you're not certain about your cash flow, what you have coming in, what you have going out, people come in and kind of give us a thumbnail of, I need $10,000 a month in expenses during my retirement. And then when we shake the trees and do our financial planning process, where we really spend time in digging in, and anybody who's done it can vouch for that, we spend a lot of time identifying not only fixed costs, what we expect you to spend on an ongoing basis, but the weddings, the roofs, the cars, all the things that come in with that. And that's all part of, regular expenses and understanding your cash flow. And that means income, because as I said, people come to us and they'll say, we're going to spend $10,000 a month. And suddenly it's $13,000 a month when we do the analysis, or it's $15,000 a month. And even if it's just for a few years, that extra $5,000 a month can really have a negative effect on your retirement plans. That's a big mistake that I see people make. So not knowing your expenses, being uncertain about your cash flow, uncertain about your expenses, and unknown expenses. People aren't considering your Aunt Irma. Everybody knows your Uncle Sam, but people aren't considering your Aunt Irma until it often hits them. Irma is the income-related monthly adjustment amount that drives up the cost of your Medicare premiums, based on your modified adjusted gross income, and it looks back 2 years. And yes, sometimes when we're doing tax conversion strategies or Roth conversion strategies and tax efficient planning, sometimes it makes sense to pay that Irma for at a higher rate for a shorter period of time rather than paying it for the rest of your life. But that's a calculation you have to do, and we do a calculation for all of our clients to make sure that it makes sense for them. But so many people aren't even considering that. It's not even on their radar. Tax on your Social Security, younger folks who, if coming into age 60, sometimes people don't realize that your Social Security can be taxed up to 85% of your benefit. Your Social Security benefit can be subject to tax. That's not 85% tax. It's 85% of your benefit, up to 85%. It could be 0, could be up to 50, could be up to 85%. But that means you may have to send a good portion or some of your money back to the federal government when you start collecting your Social Security. Tax is one of your largest expenses. Sometimes people aren't even considering that, and most large financial advisory firms won't even touch it. Now, I just grabbed this, and I'm not picking on Morgan Stanley. This is just Morgan Stanley's. Let me make this a little smaller because it's so darn long. Ooh, okay, I'm going to have to scroll it. This reads Morgan Stanley Smith Barney LLC, Morgan Stanley, its affiliates, and Morgan Stanley financial advisors or private wealth advisors do not provide tax or legal advice. Do not provide tax advice. Clients should consult their tax advisor for matters involving taxation and tax planning, and their attorney for legal matters. So they're saying, we realize this is one of the largest expenses during your retirement, but we're not going to touch it. Why don't they touch it? Because it's really complicated, and it's got you hear all the different moving parts, and well, if this, then that kind of situation. Folks, this is a pet peeve of mine. The fact that they disclaim it on and again, it's not just Morgan Stanley, it's Wells Fargo, it's Merrill Lynch, it's all the big firms. We do not give tax advice. Folks, we give tax advice. We work with your CPAs. We do tax planning. We set things up. That's how it should be. My goodness. So your tax planning and again, one of your large expenses, not checking in, keeping things on autopilot. Look at your statements. Another pet peeve of mine is when people say, oh, the markets are really challenging right now. Don't bother looking at your statements. Don't even look at them. That is the wrong way to go. You have to look at those statements and you have to be aware of what's going on. Do you have to be an expert in all the nuances of what's on that statement and the details? Well, you should have a really good understanding of it, in my opinion, but you don't have to be expert. But my goodness, if your accounts are down, don't you want to know why your accounts are down? Shouldn't you be having discussions with whomever's helping you with that, or find somebody who can help you if you don't know the answers yourself? And it's not just, well, hold on, it'll come back. For crying out loud, you've got to have, sometimes it's just a gut check, but this is high stakes stuff, because if we have negative markets, even if we have soft markets for a long period of time, it can greatly affect your standard of living in retirement, or, just your quality of retirement, or even if it's just what you are leaving to the next generation, if that's your goal. And there's no reason not to look at your statements. There's no reason not to have discussions. And there's no reason not to review it on a regular basis. So remember, you should review your plan at least once a year. And that's your entire plan. You should be having discussions on a regular basis. You know, if it's twice a year, even if it's just once a year, or open up your statement and, hey, I got questions. Why is this? Why is this down 10%? Why is this up 10%? What's going on with this? It's really important to have that. So that's number 5, but there's more. Of course, investments in the wrong buckets. You've got your taxable bucket, you got your tax deferred bucket, you've got your tax advantaged or tax-free bucket over here. Having the right amount of money in each one of these buckets can have a huge impact on your retirement distribution planning. And of course, your order of distribution and more. So they're the big ones, folks. The 5 common, did I say it again? Yes, 5 common retirement mistakes. So, but there's more. So plug yourself in, pay attention to these things I talked about today. Keep yourself educated, stay on top. This is serious stuff. If you just think about it, we call this the Financial 15, because if you just listen to this or watch this 15 minutes a week, you'll be better off than most of the folks around you. Frankly, you'll be better off than most financial advisors out there, because we talk about topics that most people aren't talking about. These IRA distribution planning, but you're going to be better off than certainly 90% of your peers out there, for sure. So just attend these webinars, attend classes when they're available to you. You only get to retire once, and it should be as enjoyable as possible. So that's it for today. We'll see you next week. I don't see any questions. If you have any questions, if you want to schedule time with us, you can reach us at questions@attleborowealth.com. That's questions@attleborowealth.com. Stay tuned for our website. Stay tuned for the recording I'm going to send you about this webinar. If you're on our mailing list, if you're not on our mailing list and you'd like to be, you can send me an email at questions@attleborowealth.com, and we'll be sure to get you on our mailing list. I guess I should put on a form to fill out on the YouTube channel for a mailing list. That would probably make sense. But I hope you enjoyed this today. I hope you learned something, and we'll see you next week. Take care.